Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior Podcast. Our goal with this podcast is to sit down with top market practitioners, understand a little bit more about how they approach the markets, lessons learned through their successful careers in the financial industry, some of the tools and techniques they're using to make sense of the markets today and in the weeks and months and years to come. Great interview today with Steve Sosnick. Steve's had a pretty fantastic career in the financial industry, starting at the 1982 low, as you'll hear him describe a little later in the interview, but going through a bunch of major Wall Street firms for the last 30 years or so, working for a number of firms, and ended up being part of Interactive Brokers, and that's where he sits as chief strategist today. We talked a lot about the AI trade, bubble signs, trend following versus valuations, buying the dips versus getting out of the way, ways to think about hedging, some of the tools, techniques, and indicators he's using to try to assess current market conditions. A fun discussion with a lot of great investing wisdom along the way. Please enjoy this interview with Steve Sosnick of Interactive Brokers. Super excited to be sitting down today with Steve Sosnick. Steve's the chief strategist at Interactive Brokers. Steve, you and I met years ago, I feel like, at a Money Show conference.
Yes.
It's been awesome to keep in touch, and I'm super excited to finally get you on the Market Misbehavior Podcast. So welcome.
Thank you so much. It's a real pleasure to finally join you for this. I'm looking forward to our discussion.
For sure. So I feel like our cup runneth over with things we could talk about given the market conditions. I'll start, if I could. If you'll indulge me, I'll start with the infamous John Templeton quote: "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." I'm curious, Steve, where do you think we might be at on that sort of idealized pattern, idealized cycle of a bull market, and why do you feel like that's where we're at?
I think for better or worse, we're probably closer to we're certainly in the optimism stage. It's tough to always figure out where the euphoria stage is. I think right now, one of my little truisms are markets have a nasty way of making the maximum number of people wrong at the most inopportune times. So I don't know that we've gotten everyone on the dance floor yet.
Yeah.
But I certainly find it hard to believe that there are a lot of wallflowers out there who have not joined these markets.
It's a very good point, and I would probably tend to agree with you. And it strikes me, Steve, just with different commentators, strategists, this is one of those times where there's some people making an aggressive argument that the AI trade, euphoria-driven trade, for lack of a better word, just is in the early stages, while you have others talking more about valuations, however extended they are. It's the most obvious bubble ever. How do you reconcile those two kind of competing perspectives here? Because I think both of them, you could argue both, and I think have some decent evidence to back it up. How do you reconcile sort of those two competing factors here?
I reconcile them with this phrase: a market can remain irrational much longer than you can remain solvent. And I wrote about this earlier this week because, just in a group chat with a bunch of college friends, one of them posted The Economist. There was an article in The Economist basically about, are we in a bubble? So I don't remember if that's the exact title, but along those lines. Threw it at me to respond. And I gave him a response, and I realized, wait a minute, I gave these guys all the good stuff. So I wrote it up for our readers on Tuesday. And maybe Tuesday, Wednesday, I forgot. The days are all blurring. I forget exactly when everything transpired. But basically, the article points out some interesting stuff. First of all, that, at various points in the 90s, you had people like George Soros, Peter Lynch, Julian Robertson, I'm forgetting a few, basically saying that this market was overvalued. Problem is, they all shorted the market in the mid 90s, like 96, 97, 98, and to various degrees got carried out or missed it, or Buffett's case just sort of missed it. So there's a lot of smart people who have a history of being wrong at this kind of thing. And these things can go on for quite a while. Now, I don't I still find myself in the camp of not thinking that we're in the early innings, but we're in the later innings. And my reasoning for that is, yes, we had a bear market in 2022, but essentially we've been on and we had, sort of the COVID crash of 2020. But beyond that, we've really pretty much been on a dead bull run since 2018. And before that, we were on a bull run from 2009. So, I mean, people have really gotten accustomed to the idea that markets move up and to the right. And so, I think it's fair. It's always fair for any investor, no matter what you're investing in, whether it's stocks, bonds or real estate or Pokemon cards, about what your expected rate of return should be from that investment. And that investment right now in AI, I think, is much more uncertain than people say. A question I was asked recently was, are we in a frothy are we in a frothy market, or will the promise of AI prove to be true? And my answer to him was that's not really, they're not mutually exclusive.
I was gonna say the answer might be yes, right?
Yeah. And I do point back, I hate to use too many 1990s analogies, but that was the case. The internet was everything that everybody thought it would be, and then some, and it brought all the productivity, et cetera, et cetera. But were they good investments in the later stages? No. And by the end of this, the internet was not by the end of that period, the internet was not a secret. At this period, AI is not a secret. Everybody knows it's there. And the problem also is these things don't evolve the way that you think they will in the beginning necessarily. And so we're already seeing like reports of code red at OpenAI. Well, might OpenAI not be the big winner? Netscape didn't prove to be the big winner, but they were the first mover. The problem was Netscape, as far as I know, hadn't committed to spend $500 billion on data centers and chips off a revenue base that optimistically was $20 billion. That would be $20 billion when they made the commitment. So a lot is riding on this one company's success. Yeah. And in general, a lot of it is right. All of us, those of us who invested in these companies, the managements of companies, the big hyperscalers have gone from being asset light and, revenue rich, which is, sort of the holy grail of investing, to spending huge amounts of their free cash flow on this very uncertain prospect. So another couple things that I would bring to mind is unpleasant precedents. Number one, we saw this movie before to some extent in the build out of bandwidth in the late 90s, right? There was a huge rush to build out bandwidth. Again, I will stipulate we needed the bandwidth, and we're probably speaking on some of that bandwidth right now. On the other hand, but who laid that bandwidth? Global Crossing, Lucent, WorldCom, Enron, Northern.
None of those charts exist anymore, by the way, Steve. Right?
There's a reason I picked those names. These were the ultimate crazy trade of that era. It was actually a little bit after the 90s, I think, but I don't remember the exact timing. I ran our market making in Canada as well, as well as doing in the US.
Okay.
And there was an investor up north who did the math and said, Bell Canada, BCE, owned a huge stake of Northern Telecom. They were the majority. I don't know if they were the majority owner at that point, but they were a plurality owner. And Northern Telecom, because of their role in bandwidth, was valued at multiples of Bell Canada, BCE. And so the logical trade would be short Northern Telecom by BCE, except the guy got carried out. Because again, the market can remain irrational longer than you could remain solvent. The trade proved to be correct. I mean, spectacularly so. I don't think bankruptcy was in the cards at that point. I think it was just more that BCE's market cap would recognize the Northern Telecom stake properly.
Yeah.
But this stuff happens. So I do worry about some of the bandwidth, data center stuff. And I think you're starting to see those worries reflected in Oracle's stock price and credit default swaps. Another thing I would say is, I alluded to the Netscape. The early winners did not prove to be the big winners. Let me remind everybody that neither Facebook nor Google was a public company during the 90s. Facebook didn't exist. And I forget exactly when Google started, but it was not really, we were using Netscape browsers via an AOL connection or CompuServe connection. We were, we were using Yahoo as our primary search engine. This stuff changes. You're talking about a very fluid technology environment. We had the DeepSeek scare early in the year, but nothing says that OpenAI, which has been proclaimed the winner and the leader, they're getting nervous about Anthropic. There's also nothing that says the best AI model isn't being developed by some kid in a garage somewhere, whether that's Silicon Valley, Bangalore. The world is global now, so the kid could be anywhere. And so, and also in terms of the use cases I've heard of, I've been speaking to people in various industries, and various people I know are starting to find that the large language models are not necessarily as useful to them as small language models. If you're a lawyer, and I spoke about this with a couple of lawyers at Thanksgiving, thanks to the nature of my family, they're finding more use in very focused legal models. Because you know what? They know that everybody knows about ChatGPT and the others sort of hallucinating and pulling up phantom cases and stuff because they're looking everywhere. If you have a model that's strictly focused on reading legal precedents, Westlaw, et cetera, it still needs to be error checked. Let's put it that way. But it's going to give you better results. I would imagine the same applies if you're an engineer, if you're a coder, if you're any number of different things, that maybe small language models, which don't require this giant build out that we're going through, might be the way of the future. I'm not enough of a futurist to guess on that, but I am enough of a historian to know that the early winners are not necessarily the end game winners.
No, there's so many great points in there, Steve, and 100% agreed, right? I think a lot of people confuse the idea of the upside for the technology, which is undeniable, right? I mean, late 90s, if you said the internet and web browsers are going to define people's life for the next 20 years, you were 100% right. But if you bought the wrong companies, you got absolutely crushed during that period, right? And the companies that eventually really came out on top were not the ones you probably would have guessed back then. And there were
the only one was Amazon, right?
Right. That actually weathered it and got through that, right?
Yeah.
100%. That's great. So, thinking and based on what you said, thinking about this current market where the market has just been grinding higher, particularly off the April low, it's sort of, we keep making higher highs, we keep making higher lows. So dip buyers have been rewarded handsomely so far in 2025. When you think about the concerns about what you talked about, right? Just the fact that the play on these AI names is starting to change, given the fact that they're now starting to be a little more debt heavy. They're spending a lot of money versus being very cash rich and not taking on those sorts of liabilities. How does this end? I mean, what's the thing, or how would you sort of differentiate the continuation of buyable dips to that last one? I was taught, one of my mentors, Greg Morris, used to say, all new highs are bullish except for the last one. So what would you use to sort of figure out that dip that is not buyable, but this is the beginning of something that's a lot more negative? Is it some sort of change in the macro conditions, or is it something with the companies themselves that you think would sort of tip the scales the wrong way?
I think it's when you start to see a pattern of lower highs and lower lows. At some point you start to see the trend change. Because I put out a piece earlier this year, and basically saying, death taxes dip buying. Those are three things that are inescapable. And to be fair, if you had an unlimited amount of money and an unlimited time horizon, every dip has been a buying opportunity. As we're speaking, we're in spitting distance of all-time highs.
Yeah.
And so, with the exception of had you bought at the absolute top on October 29th, and even then your drawdown is not exactly huge.
Yeah.
Every dip has been a buying opportunity. But the problem is nobody has either of those things. We all have a finite amount of money and we all have a finite amount of time. And at some point we do have to start to wonder, as you get closer to, retirement age and your needs change, can you speculate that same way? I think we have one of the benefits that's benefited dip buying is, number one, it's been relentlessly successful for so many people for such a long period of time. That can, of course, breed complacency, but let's leave that aside right now. And I think I don't know the right word, youthening, the number of younger investors with, if not infinite time frame, multi-decade time frames who can withstand it. But the problem then is capital allocation. So yes, if you see every dip as a buying opportunity, at some point, right? Like this, what's the proverb? If you're a hammer, everything looks like a nail. If you've been a dip buyer, every dip looks like a buying opportunity. The problem is, are you leaving dry powder in case that specific time that you bought the dip is not the ultimate dip? Or are you going all in and then finding yourself at a point where, oh wait, I'm fully invested and I have my rent is due, or my my car payment is due, or my mortgage is due, that kind of thing. That's where it becomes trouble. We haven't hit that point yet. The closest we came recently was the tariff tantrum in April, but that was really so short-lived.
Yeah.
And in many ways, I'm going to call it a self-inflicted, an own goal, a self-inflicted problem that it was able to turn around very quickly. I think, we have not seen this period. One thing that kind of sticks in my mind here is, in late 2021, the NASDAQ peaked, I think, in mid-November, and the S&P finally peaked, I think January 2nd or 3rd or whatever. And then that was the high. That was the high for, pretty much till 2023 sometime.
Yeah.
And so I do start to wonder, if we're not going to see, if we fail to see leadership from the big cap, the mega cap tech stocks, whether you like them or not, they have to hold up their end of the bargain, being 40% of the S&P 500 and call it 50% of the NASDAQ 100. There's really no way around it. So someone asked me the other day, what if somebody wants to get into the AI trade? What should they do? I'm like, if you're just buying spiders, if you're just buying S&P 500 mutual funds in your 401k, you're heavily exposed to the AI trade.
You're taking on a huge AI bet all of a sudden, right?
Yeah, exactly. Or if you just own S&P 500 mutual funds in a 401k, you're 40 to 50% exposed to AI, whether you want to be or don't want to be.
It's so funny. I feel like an unintended over concentration for a lot of investors' portfolios right now, right? You buy the S&P 500 thinking you're getting broad diversification. You're getting very narrow concentration in 10, maybe 20 stocks, and then a little bit of a bunch of other ones, right? Is how the math actually works out. So for investors that do find themselves in that sort of environment where you have a big AI bet, you're concerned about what happens from here. And maybe we're in the later innings. Maybe the next dip is not a dip and the beginning of something further. How do you think about managing risk in this kind of environment? Is it diversifying in other areas of the equity space? Is it leaning into other asset classes? Or what are some of the ways you would suggest people think about managing risk given the uncertainty right now?
There's no real one way to do it. So I'm going to give a couple of different processes that might work for different people. If you want to remain invested in stocks, I would say look more toward the value sector and less toward the growth sector. I've always found the distinction between growth and value to be somewhat arbitrary, but you got to draw the line somewhere. But I would lean toward value stocks as opposed to growth stocks,
Hmm.
because again, we've been as a market, we've been worshiping at the altar of growth stocks, and does it mean that value has its day? Well, maybe not. There's a reason some of these stocks are value stocks. But what it means is, if you're concerned about risk levels and concentration, you got to zag a little bit where everybody's zigging. So you move to lower beta names, you move to higher dividend names. That's a way to do it. If you're more aggressive, well, that's where the options market comes into play. You can aggressively hedge or even speculate about the downside. Obviously, there's no one size fits all, but that's kind of the two ends of the spectrum. If you want to be fully invested, or if you're just willing to roll the dice, there's two different ways to do it. I do sort of caution again too much about getting too short here, because again, the historical precedent is not great. You kind of, as I put in the piece the other day, the 10-year track record, if you invest at times of very, very high valuations, whether you use PE or capital adjusted PE, CAPE, or the various measures,
Yeah.
there tends to be an inverse correlation between valuation and return over, let's say, a 10-year period.
Mm.
Over a 1-year period, it's literally a crapshoot. There's almost no correlation.
Right.
So, be very judicious in what you do. So I think I've used the term various times, don't fight the tape, but insure against it. That's again for more aggressive traders or those who are more comfortable using options. But the other way to insure against it is de-risk a little bit. By the way, another way to de-risk a portfolio is raise cash. While we're still getting positive rates on cash, while we still have, although they're likely to come down, while we still have positive real interest rates,
yeah,
you're not getting paid as much to wait by any means, but you're not losing money by being on the sidelines right now.
Yeah.
So that is another way to simplest way to de-risk, raise cash.
I love it.
And it's
Don't forget about cash
as
as a decent place to hide out, right? When you're waiting for the next move. So when did you get started in the industry? You've alluded back to some late 90s action. When were sort of the formative years of Steve learning about trading, investing, and kind of getting your feet wet?
I started as a summer intern at a company called LF Rothschild in 1982.
Yeah.
LF
At the 82 low. That's awesome.
I was there for like the 82 low. That was my summer. I remember talking to someone about CD rates being like 18% at the time and the stock market like being in the absolute toilet, which, that was pretty much it. So I was literally there when that changed hands.
Yeah.
Somewhere along, I worked for them for a couple different summers, and along the lines, my first job was like in the research department, which was a great learning experience, and partially by being the guy who knew how to, the college, just like you have the college student who's always at the cusp of things. I was the one who knew how to use Lotus 1, 2, 3. Speaking of early early technologies that proved to be great but weren't the ultimate winners.
Yeah.
But then, I got to go up and spend more time on the trade. I then sort of worked for the firm's technician at the time, a guy named Bob Ritter. And I would end up spend more time on the over-the-counter desk. And I realized I love the trading stuff. So then by the time I worked a summer at Salomon Brothers, and this would have been 1985, 86, 85. Took a job there, I pushed it back to January 87 was when I started the training program, which meant I finished the training program just in time for the crash of 87. 87 was a weird year to be in the training program because it was a grinding bear market in bonds, and Salomon Brothers was a bond house historically.
Yep.
And all the fun was on the equity floor, which was historically not the case. If you read Liar's Poker, that was the place you didn't want to be. Well, as it turns out, it kind of was the place to be from my training class. Doing government bonds seemed kind of dull at the time. Also, as it turns out, the guy I would have worked for, the guy I might have worked for, ended up running into some trouble for fixing auctions and things like that. So it was a good miss. But anyway, went to work Solomon Brothers, and then went to, then my department, one of these like late 80s, early 90s things. My department got poached by Shearson, Lehman, Hutton, American Express, whatever the hell they were calling the firm that month. My business card kept changing. Did that for a while. When your business card changes every 6 months because the name of the firm changes, it's probably not the most stable place to work. So I found a job at Morgan Stanley. I realized after the third big firm, that maybe I'm a smaller firm guy. And so when the opportunity was offered to me from this relatively small market making firm, because who was getting into, was starting to get into individual equity options market making, and needed someone with both derivatives experience, but a heavy equity experience. I joined this little firm called Timber Hill. Some people I knew in the options business said, they seem to be a good firm, but they're kind of odd, and a lot of people there's a lot of floor people, and they run through them a lot. Well, 30 years later, I'm still here. The firm is now Interactive Brokers. And I've had several different iterations from, managing risk in a options market making portfolio, helping to manage that portfolio, expanding us into Canada, then becoming a talking head along the way. And then as the firm exited market making, because I'd become a talking head to some extent, I stayed, and my market making colleagues, for the most part, the market making division was bought by Two Sigma, the big hedge fund, who has since actually closed most of it down. Here I sit talking away.
It's a pretty incredible journey, Steve. So it strikes me, you starting in 82, getting through the 87 crash, getting through, all sorts of crises along the way, the tech bubble, et cetera, et cetera. Talk to me a little bit about market structure and how that's evolved, because there have been so many changes. From decimalization, et cetera, all the way through more recent, dark pools, high frequency trading, algorithmic trading. Now we're getting into like zero DTE options. I feel like every year or two, there's this severe, structural change. Out of those changes that you've observed, what stands out as a really good change to market structure that you think has helped the retail trader? And what concerns you, if anything, about structural changes that you've observed here recently?
How about we make this part 2 of our, because this is what the question you just
asked.
It's
a day-long seminar, right?
Literally a podcast unto itself, if not a multi-episode series. So in the interest of brevity, I'm going to say that the trend, which I will say I've been fortunate to be part of, and Thomas Petterfy, my boss, was really the guy who was always like 3 moves ahead of everybody. The trend toward electronic trading and greater automation. And that has allowed markets to expand in a way that we never could have imagined. Earlier this week, I happened to be at the head of the SEC, Commissioner Atkins, gave a talk at the NYSE, and I was fortunate enough to be invited. This room of several hundred people, various people from around the street, but they also had a lot of people from the exchange itself there, a lot of their employees. And I happened to sit next to this woman who was in technology at the NYSE. And she was stunned when I said, when I started my career, one of the things I had to do was just chase a floor broker. And I explained that, the mechanics of finding out what was going on the floor. And, you had the salesman would ask the trader would phone the booth. He had to know which booth to call because the floor was a big place. Phone the booth, ask the question. Then the clerk would flag down the trader, get him to run out to the crowd. He'd get the picture, send it back up. It went back up the chain. Then with that information, the buy side trader would call the salesman, and you'd have an order placed, and it would all be. And it meant the language was very precise, because think about like that game of telephone being played with millions of dollars. But she was just like, wait, this used to happen. This was she knew that there was a floor there. This woman was very bright. So it's not like I was talking to some person who fell off the truck 5 minutes before. But she is involved in the amount of technology that's involved in keeping any exchange open, particularly the NYSE.
Yeah.
But she hadn't really fully appreciated the amount of time and effort required to just place an order.
Yeah.
Find out what's going on in the market. You could see from your Quotron what the bid and ask was, but when you
Sure.
go out in the crowd, or you'd see like, oh, this guy's been lurking in the crowd and he just keeps buying, and there was more nuance to it. But that's the short answer. Is we are all the throughput, all the wiring, all the computer power, and all the and yes, the algorithms that run all this stuff. That's been the change, and that's been the sort of the inexorable arrow of progress. And I consider myself quite fortunate to having been in the seat I'm in, having been a part of that.
It's funny looking back from 2025, thinking that trades were agreed upon by two different people jotting down a note on two different pieces of paper, and that's how millions of dollars would change hands is pretty laughable now, but it was pretty serious. It was legit at the time. Final question, Stephen. This has been an absolute pleasure. I appreciate the discussion of the market outlook. I appreciate some color on your experiences. This has been awesome. Tell me this: if you had the opportunity to go back to a young Steve Sosnick, just sort of getting started, what would be the one piece of advice, the one sort of guiding principle that would help Steve have a successful career?
Don't be seduced by names. I think had I granted, Salomon Brothers was a great place to start. I probably shouldn't have left. I shouldn't have left to go to Lehman Brothers, but they were seduced by money. That's I guess. But when that wasn't working out, I was just like, oh wait, Morgan Stanley. There's another big name. Let me do. So I wish I kind of had been a bit more entrepreneurial minded, or looking for the better long-term target early in my career. I was fortunate to find it when I did, and I've certainly no regrets. Obviously, I wouldn't still be in the same place 30 years later if I didn't like it. But I will say that don't assume that what you're doing at one point in your life is what you'll be doing later in your life, and find a place that offers the opportunity to make changes. Because again, if you would have asked me 20 years ago, would I be like a talking head, writing for, I was writing algorithms and making, and testing risk models. And somehow along the line, I got a whole new career while literally sitting in the same seat.
Right.
And so just, be flexible. Don't just because someplace offers, sounds great. It may or may not be the right place for you for the long term. And think about who's moving the ball forward and why. And that's really, and how can you be a part of that?
Steve, that is awesome advice, particular for people just getting started in the financial industry. I hope the right people are listening to what you just said. Listen, the clients of Interactive Brokers are certainly, I think, probably appreciative and very much benefit from your expertise and your experiences. So thanks for what you're doing there, and thanks for giving us some time today. Great to chat with you, Steve.
Same here. I really enjoyed this guy. I'm looking up at the time going, oh my gosh, we've been at this for a while.
It goes quickly, right?
It does. So thank you so much for that. I really appreciate this, the opportunity.
For sure, Steve.
And take me up on the idea to talk about part two, the evolution of
part two to come, for sure. Okay. Thanks, Steve.
Sounds good. Thanks.
It was a lot of fun, that interview. There are a number of quotes. I was scrambling to write down some of the things he was saying. I love, you got to zag when others are zigging. That I might take and attribute openly to Steve. I think that's a fantastic one. Don't fight the tape, but insure against it. Great way to think about, the balance between trend following and money management, right? Following a trend, but when you get concerned, using options, using hedging strategies, using something to sort of cushion yourself or insure yourself against the market turning against us. I think that was the fantastic way of thinking about the markets here. Obviously, a large discussion about the AI bubble, and again, talking to someone like Steve, who really was able to understand and appreciate sort of that mid to late '90s period and the incredible growth. And I think his point about how a lot of people confuse the opportunity and the upside for the technology versus the opportunity and the upside for particular stocks and companies. Most people sort of blend those very purposefully, and I would say that you should try to separate those, right? Plenty of .com companies that seemed to be a great play on the growth of the internet, which is 100% correct, ended up being absolute disasters, and it took years and years and years to finally get out of that secular bear market that started in 2000. You can see the same thing about a number of different sort of big up and coming growth areas, and the first adopters, the first to market, the popular ones early in the growth of that theme may not be the ones that last the longest. So focus, and again, that's why I find focus on charting and technical analysis is so valuable, right? When the companies are the right companies, the charts are going to be reflecting of that because the price is going to be generally trending higher. Really appreciate Steve's comments, particularly at the end. I love that question I was able to get him to answer about, go back to a young Steve Sosnick and what would you tell him? And I think that little, minute at the end where he talked about, as a young financial professional chasing the name of the firm versus finding areas and roles and firms and opportunities that give you a chance to grow professionally and personally in a way that is in line with your own personality characteristics, your own strengths and weaknesses, I think is absolutely true. I have experienced versions of that through my own career. I know looking back places where they were good in some ways, but not the right fit in other ways. And every one of those experiences has helped me refine better and better to identify a really good place where I'm happy to be right about now. But I will tell you, unfortunately, the financial industry filled with, I would argue, a lot of unhappy people that chased the name of a firm, chased a paycheck, and are dying a slow death inside. Their soul is being crushed. And I will tell you, there's no amount of money or prestige that is worth being completely unhappy with what you do. So I really appreciate Steve, going that direction with a fairly open-ended question. What a fun interview, and obviously a really smart, a great experienced, financial professional willing to share some lessons learned. So thanks again to Steve Sosnick of Interactive Brokers joining us today from New York. By the way, if you want to learn more about some of the tools and techniques I and my other technical analysts in the industry use to navigate periods of market uncertainty, to follow the trends but identify changes of character and meaningful corrections to protect ourselves against the next cyclical or secular bear market phase, our Market Misbehavior Premium memberships may be a great opportunity for you to upgrade your own investment process. 3 great benefits to the premium membership. First off, we have a bunch of virtual courses you'll have immediate access to. Flight School Behavioral Investing is where you'll start. It's where you'll learn all about behavioral biases, technical analysis tools and techniques, and how to have a more structured approach to your investment process. You will also have all of our member reports, like our weekly flight plan, which is our core report that comes out every weekend, our monthly chart review, which we just issued for December, where we take a step back and apply our proprietary market trend model to a series of ETFs and asset classes to understand what's working and what's not and what's changing. Finally, you'll have full and immediate access to our member community. That's where you can ask questions. That's where you can learn from others, be part of a growing and passionate community of like-minded investors trying to answer the same questions you are, trying to navigate these markets and learn about charting, technical, and behavioral tools along the way. You can get access to all of that today by going to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for tuning in for the Market Misbehavior Podcast. I'm Dave Keller, here to remind you it's always a good time to own good charts.